Welcome to our second episode of Philotimo and Friends. Our next guest is Bianca Batty, CPA, Chartered Professional Accountant Extraordinaire. And we're very excited to have you on. She drove all the way from Uxbridge to be here today. So very excited for a great conversation.
Yeah,
Bianca,
thanks for having me.
you're welcome. My pleasure. The pleasure's all mine. So you're a Chartered Professional Accountant, and tell me a little bit about your history. How'd you get here?
I graduated from Western, and from there I went and worked at BDO in public accounting for a few years. Then I jumped around a couple small firms as I got my CPA designation. And then a year ago I went off and now I work for myself.
Awesome. And congratulations on that. That's a big move and a tough one. So tell me a little bit about how you decided to make the jump from more of a corporate environment into working for yourself.
A lot of pressure from family and friends, kind of. They thought, why are you working for someone else? Because they had confidence in myself, which I don't often have, that I could do it. And yeah, and I was looking for a little more flexibility. The 9 to 5 sitting, I was getting a little sick of that. So
now you work like 7 to 6 or something like
right,
that.
exactly. I do. I work a lot more.
Especially over the next couple of months
Yes.
with taxes. So
Mhm.
and on that note, so tell us a little bit more about what you do on throughout the year, and maybe especially during this time is obviously a bit more busy. So tell us a little bit more about that.
Yeah, I work for a bunch of different small businesses and some not-for-profits, and I do like their daily bookkeeping, monthly bookkeeping, payroll services for them, HST filings. Then I do corporate tax returns, and then of course personal tax filings.
And you're gonna help us out here, and we're partnered up together. So one of the reasons I did twist your arm to get over here was so we could have an introduction to the clients that being a partner between Batty Accounting and Philotimo Wealth, working together to get clients' taxes done, and looking forward to that partnership this year and many years in the future, hopefully.
Yeah,
There we
yeah.
go. Awesome. Great. So our first topic today that we're going to run through a few topics today, tax related, that questions that often come up that clients would ask yourself or myself, and just talk about a few examples and some things to look out for. So first thing we wanted to chat about was capital gains and real estate tax considerations, having rental properties and stuff. But on the capital gains, I think there's been maybe not an interesting thing, but maybe a bit of a mess of a situation. So talk to me about that.
Yeah, the government was looking to change the capital gains inclusion rate. So for years, it's been 50%. So 50% of your capital gain was included in your income. As of June, I think it was 24th, 2024, they were upping that to 2/3 of the capital gain would go into your income.
Clarify for me the breakdown of what that change potentially was.
Yeah. For individuals, if your capital gains are under 250,000,
Mhm.
you're still the 50%
Normal 50%
inclusion.
is taxable income.
Yeah.
I got you.
Anything over that would be at the 2/3 inclusion rate.
Okay.
But for corporations, all your capital gains are at the 2/3 inclusion rate.
Gotcha. Okay. Well, it was all kind of confusing and left open to interpretation, I feel like.
Yeah. And then now with the Liberals stepping down, there's a lot of talk that this isn't even gonna pass. So
Mhm.
CRA is still saying, no, you should file as if this is the case.
Okay.
But it's probably not going to be the case. So it's kind of up to people.
And so how did you manage that? I know we had conversations with clients about that as well, but how did you manage that through the process with clients, and what's your advice on how to handle that?
Yeah. I don't think you want to jump into with something like that where it's so unknown. You don't really just want to like panic sell all your investments.
Yeah.
An old boss of mine actually always used to say, don't let the tax tail wag the dog. So
I
if
like that.
you were,
Okay. I'll write that down. That's a good one there. Okay. We're going to steal that one here. Nice.
if you were planning on selling the investment anyways, then fine. Maybe it was a good idea to try and do that before this came into place,
Yeah.
but you'd hate to sell something just because you're freaking out about paying more tax on it.
Yes, yeah. And yeah, that's a great point. And the uncertainty just, you don't want to make a decision based on, yeah, like you said, that's good. And we wanted to talk a little bit about more properties now and the capital gains potential effects on that. So obviously we have clients that have rental properties and are collecting rent, but let's start with the principal residence and how that might look.
Yeah. If you sell your principal residence, it's actually a tax-free sale.
Mhm.
So you don't have to pay on any tax on it, on the gain that you make on it.
Yeah.
But you do have to report it. The CRA still wants to know about that sale. So you need to put the year that you sold it or the year you bought it, how much you sold it for, and then the address. And you have to actually like sign a form that says, yes, I lived here. This is my home for all of the years that I owned it.
And even if you haven't sold it, am I correct in saying that you do have to report every year that that's your principal residence, or only when you sell?
No, just when you sell.
Just when you sell it. Okay, sounds good. So when you sell it, you got to let your accountant know
Yeah.
you've sold a principal residence so that they're aware of that. Yep, sounds
Yes.
good. Yep.
Yeah.
And on the rental properties, so this is always a big one that comes up and adds a layer of complexity to tax returns. So talk to me about property flipping rules that have come into place and maybe some tax implications of rental properties as well.
For sure. The property flipping rules actually are in with the principal residence exemption. So
Okay.
it's a new rule that came last year, I believe. So if you sell your home, even if it was your home, you didn't rent it out at all, and within 12 months of living there, you are deemed to have kind of flipped it. So it'll be business income, which means
Gotcha.
100% of the gain would be in income as opposed to the 50% if it was a capital gain. There's a very limited exceptions, like if you die or you get divorced or if you're moving for work, then the CRA will allow it, but it's kind of, yeah, it's hard to get out of that one. But hopefully,
Who's buying and selling it within a year?
I know. I mean, I had somebody call me and she just happened to sell her house within a year, and she didn't meet any of the reasons. So I'm like, I think
So you potentially fall into
yes.
the trap of not qualifying for that principal residence exemption and having a potential tax bill.
Yes.
Depending on, I guess, the growth of the change in the value of the house
Exactly.
would affect that. Yeah.
Yeah.
Interesting. Yeah. And so some tax implications of rental properties we wanted to chat about was some deductible expenses and repairs versus expenses and improving the house, that kind of stuff. There is a question that we often get when clients are saying, I want to do this at my rental property. What should I do? What does it look like? So coming to us and having that conversation. So talk to me a little bit about that.
Yeah. Well, some deductible expenses for your rental property are like the obvious, like property taxes, insurance, utilities if you pay that. Then there's also the mortgage interest, advertising, and any travel that you may do back and forth to your property if you have to do work on it or whatever. And then so what you were saying with the repairs and maintenance versus the capital expense.
This is always the interesting one that
Yes.
you're trying to figure out the pros and cons of both. So let's maybe chat about what those two things mean, and then maybe we can go over an example or two.
Yeah. So a repair, the CRA says, is something you're fixing something in the property. So you're making the property as it was before. Something broke, but you're fixing it to how it was. But capital expense is you're improving the property. So you're improving the value somehow. And then if it is a capital expense, you need to capitalize that and you depreciate it actually over a number of years versus writing it off in the year you had the expense.
Okay. So it's so the capital expense where you can potentially depreciate it over those years is more for something that's you've done that is improved the house and increased the value of the house potentially.
Right.
So what would be an example of something that Again, every situation is unique, as we've talked about, but I mean, generally speaking, what would be an example of something that would fall into maybe either of those categories?
Yeah. So, say your tenants ruined your carpet. They
Hmm.
had a party. It's completely destroyed. So you replace the carpet.
Yeah.
That's repairs and maintenance. So you can write that off the
Hmm.
year you spend it.
Okay.
But if you replace the carpet with hardwood, then the CRA says, well, you're improving the value. It's a better product you're putting down.
Hmm.
So that would be a capital expense.
Gotcha. So the expense, like replacing the carpet with hardwood, is better because you can get that tax savings immediately in that year.
Carpet.
Carpet, sorry, the carpet to
Yes.
carpet. Gotcha. Yeah,
Mhm.
like we're fixing the carpet there,
Yes.
and then doing a bigger improvement would be you spend $30,000 on something. It takes time. You don't get the full 30,000 expense in that first year.
Right.
Before you go ahead with a project, reach out to your accountant or your advisor and at least have the conversation about what it might look like for you tax wise and maybe different ways. Make sure you keep your receipts, different ways you could handle it or do it to make sure you're keeping everything above board and you don't have any surprises.
Exactly. Yes.
So the next thing we wanted to talk about was depreciation of your rental property. And a lot of times clients come in and maybe they had not a lot of expenses in that one year. So they're faced with a tax bill because their rental income is going on their tax returns. So they're faced with some tax owing
Mhm.
without a lot of expenses in that year. So one of the solutions is to depreciate the property. So talk to me a little bit about how that might look and when it might make sense and when it might and what the perils of it,
Yes.
which we know. So go ahead.
Yes. Yeah. So you have the option to write off the property over however many years,
Mhm,
a percentage each year. But
mhm,
so, yes, it'll save you taxes each year that you are operating the rental property.
mhm.
But when you go to sell, essentially you've told the CRA, my house is worth a lot like lower because of wear and tear over the years. But when you go to sell it, if you sell it with for a higher amount than
Mhm.
what you've written down the value to be,
Yes.
there's this thing called a recapture,
Mhm.
which then gets added into your income. So you end up with a larger tax bill.
And it's not even a capital gain. It's recapture as income, so
Yes.
it's taxable at 100%
Yes.
rather than the capital gain,
Hmm.
which would be your cost base to what you sold it for.
Yeah.
And I think that's the thing that gets clients is you oftentimes don't remember the savings that you had back in those years before
Hmm.
when you would have had to come up with that money to pay the taxes. We deferred that, but then the rooster comes home to roost
Yes.
and then you have to pay the piper. You have to pay the tax man. You don't like my metaphors there?
They're really good.
Okay,
No, yeah.
perfect. And it can be a bit jarring because you sell your house for $1 million and you think you have some capital gains to pay. You go, whoa, wait a sec, I got this recapture here and now I owe a lot more money. So
Hmm.
it's a tax deferral strategy that can make sense in some scenarios, but
Hmm.
you got to be mindful of it and make sure you have some understanding of it so you're
Yeah,
not caught with a surprise when you do sell it in the future.
exactly. Hmm.
Moving on to our next topic here, small business and corporate tax planning. So this is another more complex subject for some self-employed clients, and I'm sure you have a lot of those. And as well, you have that knowledge and experience doing corporate tax returns as well. So something to talk about there too. So let's, to start, um, maybe we can talk about self-employed versus incorporation.
Yeah. So I always kind of recommend to people, self-employed is great, and but as soon as you're making too much money that you need to live on, then it makes a lot more sense to incorporate because there's the option for tax deferral. Because when you're self-employed, everything you make, you're paying tax on it. But if you are incorporated, then you can hold some of the funds in the corporation at a lower tax rate, 12.2%, and then pull it out personally when you need it.
Yeah, so something like if your business was generating $300,000 of revenue and you could live off of $150,000, there'd be some serious thought to be given to incorporating,
Absolutely.
which would
Mhm.
keep that $150,000 difference in the corporation at a lower tax rate and kind of defer those taxes for future where you can manage pulling that money out.
Yes.
Yes,
Yeah.
yeah.
Hmm.
And sometimes too with incorporation, there's some liability benefits as well. But I wanted to focus more on the tax side of things for this conversation. So, and maybe the how does Canada Pension Plan work with self-employed versus an incorporation? If you're self-employed,
You're paying both. You're paying the employer-employee section
yeah.
portion on your tax bill each year,
Mhm.
and then for if you're incorporated, it depends. It depends if you're going to be pulling out a salary or you also have the option to pull out dividends. So
You're an expert. Well, look at this perfect segue into the dividends versus, you beat me to it. A perfect segue here into dividends versus salary.
yes.
So go ahead.
Yeah, so you have the option, which is great for when you are incorporated. And there, people often think though salary or dividends are a way to save tax. They end up being slightly cheaper overall, but the tax system was designed that no matter how you take out your money, you're going to be paying the same amount of tax between the corporation and yourself personally.
Yeah, your corporate tax rate is lower, but when you combine that with the dividend one, you're paying basically the same. Is how
Yes.
they always get their money, those people.
Yes, they do. Yeah, yeah. And then with a dividend, like you don't have to pay the CPP on it, obviously. And then you also don't build RSP room, which is something maybe for people to consider. So yeah, if you are want to pay the CPP, if you're trying to build that RSP room, then a salary would make more sense for you.
And sometimes, going back to what I think is the common theme of this is having a plan and a strategy to figure out what works for you. If you're not great at putting money aside and paying your tax bill at the end of the year, and you get often caught up with that, maybe a smaller salary helps you manage your budget for your taxes, something like that.
Yes. Yes.
And even if you have at the end of the year, let's say, or at any point in the year, maybe you're going on a trip. So you go, I'm going to take out some money from my corporation. You take the money from your corporate account without realizing that eventually your accountant's going to say, oh, well, that was a dividend and you owe tax on it.
Mhm.
So again, having a bit of understanding, you don't have to understand all the ins and outs. That's what you're here for. But having a little bit of understanding to know, hey, I should put a little bit of this money aside, or reaching out and saying, hey, I want to take some money and do this with it. What's the best way I can do that? Again, it saves you the frustration and the surprise at the end of the year where you go, what? I didn't plan for that, right?
Yes.
So that's a big thing for me too. So if you're a small business or a corporation, what are some business deductions and red flags that may come up?
One of the biggest, I don't know if it's a red flag, but something the CRA is they
Yeah.
scrutinize a lot is vehicle expenses, travel expenses.
Yes. Yeah.
I see reviews of that constantly.
Yeah.
Mhm.
And what's the difference between a review and an audit?
So a review is essentially they're just gonna check a few things. They
Mhm.
may be like, okay, send us the 10 biggest invoices from your vehicle
Gotcha.
expenses,
Okay. Yeah.
and maybe just some details.
Mhm.
An audit, they're coming in, they're looking,
Flashlight.
yes, so they're
Yeah.
looking at bank statements, they're looking at everything.
Yeah.
It's much more detailed.
Yes,
Mhm.
yeah. And what are some other business deductions and things just to be weary of in terms of red flag to CRA?
Yeah, there's the home office expense as well
Mhm.
that you can write off. You do want to be careful about the percentage of your home office that you're writing off. So you can write off, say, 10% of your mortgage interest,
Mhm.
insurance,
How do
home
you get to that number
utilities.
though?
So you would normally take, okay, here is my spare bedroom. That's my office.
Yes.
It's 100 square feet.
Mhm.
And then over the total square footage of my home.
Yeah.
And that percentage, you could take care of your whole home expenses
Yeah.
and you can write that off.
So if you had a 10 by 10 room that you had your office in and the house was 2,000 square feet, your office is 100 square feet, you would only be able to write off potentially 5% of some of those expenses. That
Yes.
that would be how to figure out the percentage wise.
Yes.
Yeah, yeah.
Yeah. And you do want to be careful of not going too high. If you are even close to like 50%, I mean, that's crazy. But some people, they may use their garage for storage
Yeah.
or stuff like that. So they
Yeah.
may want to claim a higher percentage. But then that kind of could put you at risk with the principal residence exemption because
Yeah.
you're using your home to make income, a majority of your home.
And I thought that was a great point that you brought up when we were discussing this prior to, is that what happens in that scenario? Like what would CRA say? You're using this for business, and then maybe disqualify you from the principal residence exemption.
Mhm.
And what happens?
So then you're going to be paying a capital gain, maybe
Mhm.
not on the full home, but
Yeah.
definitely the portion that was used for your business.
Again, just a red flag for them, where they get their ears perk up, where they see it, and then you put yourself a little bit more at risk without knowing how to do that properly.
Yeah.
Which is why you go to the professionals.
Meals and entertainment, that's another one that you want to be a little careful of.
So if I pick up a double cheeseburger on the way to work, I can't write that off.
No,
Okay.
unfortunately,
Gotcha.
no.
Yeah.
Yeah, if you're taking clients out,
Yes.
then that's kind of a reasonable meals expense. But for your lunch every day, unfortunately, that's just a cost of living.
Like maybe, and again, it's subject to the situation, but lunch at the office or something like that, like a work employee lunch or
Yes.
something would be probably something that's more close to being able to be written off than picking up lunch for yourself.
Yes, for sure.
But if and on that note, if you were to, maybe not an office party, but if you were to take a client out for a lunch at some point, that one would be able to.
Yes.
Potentially, yes. Okay, that's good to know. Yep. And yeah, I think at the end of the day, keeping things on track when you're a small business or you're self-employed or you have a corporation, keeping things on track, record keeping, bookkeeping are probably pretty good ways to set yourself up for success.
Yes. Yeah. Like for the vehicle, like keeping a mileage log,
Hmm.
that's going to be the first thing the CRA asks for if they're reviewing that. So it's a pain in the butt, but
What is a mileage log? Explain that to the people, because I haven't seen a lot of mileage logs out there.
it's something I recommend, but
Yes,
not
yeah.
a lot of people like to do it. So it's really as basic as every time you get in the car, you say, here's where I went. I started here, I ended here, here's how many kilometers, and this is what the purpose of that trip was.
Yes, yeah. And all that does is it just makes you more bulletproof when they come in and ask, right? So if you don't have that and you're scrambling around, it doesn't look like you have a good system. You open yourself up to further questions and that.
Yes.
Yeah. So moving back maybe to the personal side of taxes here. So maybe some tax credits and deductions that personally people might miss.
Yeah. Medical expenses is one that people oftentimes don't think about. So really you can claim anything that you've paid for out of pocket.
Yep.
So dental, glasses, prescriptions, anything like that. And then also some things to consider is if you're an older person and you're living in a home, sometimes that accommodation actually is considered a medical expense. So,
like you get your bill for your rent, and there's sometimes a portion on there that's for medical, that then you could take that out of there and then but claim that under the medical section.
Yes.
Gotcha.
Yeah. Now the medical expense credit is there's a threshold. It has to be over 3% of your net income or $2,700. So you have to have some pretty significant expenses in order for it to make any sort of difference on your taxes.
And I find a lot of clients that have a plan or a benefits plan, it's really difficult to get unless you had something major or had some major expenses. It's difficult to get to a point, if you're working and have a good benefits plan, where you could claim anything there.
Yes.
But certainly for seniors, it's a big thing that we want to make sure. And that's one that I find gets reviewed a lot.
Always. Yes. Yeah.
And so you don't have to panic.
No.
When you get that review, right? You just want to make sure you have a good accountant that has taken record of those receipts and that, and maybe even can forward them along for you to make sure that everything gets checked off and everything's good.
Yes, exactly.
Yeah, no, sounds good. And so maybe a couple others that you thought people miss sometimes.
The work from home, if you're employed, Now during COVID, there was it was a $500 credit, which was great to help people out. They've discontinued that. So now if you do work from home, you need to get a special form, a T2200 from your employer in order to write off any of your home office expenses. So yes, if your employer is willing to give you that form, that's great. But the CRA, that again, employment expenses is one that they review often, and you'll need that form in order to make that claim.
Yeah, and it's never hurts to ask, but I have found in my limited experience that companies are often hesitant unless you're in a more of a unique position there to provide that for you. Even though there's still people working from home a lot
Yes.
nowadays too, they still don't often get that document
No,
there.
no.
Yeah. Hmm.
Yeah. And then another one I wanted to talk about was tuition credits. So, yeah, if you're in school and university, any tuition fees that you paid can be written off. Or you can transfer them to a parent or a grandparent.
Which you should, in most scenarios, transfer them to your parent.
Yeah.
They're often the ones paying for it.
Yes.
So there's a $5,000 amount per year per kid. I guess
Yes.
that goes up. That would go up to the parents and be put on their return as a
tuition credit.
Okay, yeah.
Yes. Yeah.
And what happens if little Timmy goes and gets his tax return done somewhere else, and maybe you're doing the parent's tax return, and they say, "Oh yeah, no, we want to take that." So you put the $5,000 tuition credit on theirs, but you didn't do little Timmy's return, and he said, "No, no, no, give me the benefit of it," or didn't say anything at all. So now we have an issue where it's been counted on two people's returns. So
Yes.
what happens in that scenario, and how to avoid that?
Yeah. I guess you just want to kind of be open with communicate with your family members.
Yeah.
Yes.
Yep.
On, are you claiming this or am I claiming this credit? Because yeah, if
Maybe start with, I'm claiming this, so make sure you
You're
claim
not.
it as well, and that you're. And I don't know. I mean, I use it simply to say you tick the box to say this is going up to parents or whatever. Yeah.
Yeah. Or else then Timmy is going to be carrying that forward and he'll use it, and the CRA is going to catch, oh no, that went up to your parents that year.
Yeah.
So
And it creates a headache and it creates problems, and yeah. So you want to, like you said, be open to having the conversation with your kids, and whether they go to use a different accountant or not. We want to be having those conversations to avoid additional CRA letters.
yes.
Yeah, no, that's perfect. And in terms of maybe the next topic here, navigating the CRA and some tax compliance. And so where I wanted to focus this was about managing back taxes and payment plans. So we are both big proponents of having a good plan, and I think you'd agree tax planning is a year-round strategy. If you show up on February 27th and you say, want to make an RSP contribution, it's difficult for us to get that in place in that short time frame, right? So having a good plan in place throughout the year is important, so that you can avoid the big surprise of, oh, I owe money. What happened? I don't have this money. What can I do? So tell me a little bit about what that situation might look like, and what options people have if they can't pay, and what they can maybe do to avoid that.
Well, first, don't just avoid filing if you are like, well, I'm not going to be able to afford it anyways, so I might as well just not file, because then you're going to get slammed with a late filing penalty, which
Yes.
is 5% of the balance that's owing. So right off the bat,
Yep. That's all right. You talk with your hands. Tell the people. The people
fired up.
The people need to know. And I agree with you wholeheartedly that I think a lot of people just go, you know what, I'm just going to take this thing. I might owe money here, and I'm just going to put it, and I'm just going to stuff it down over here for now. And I'm going to see what happens with it. And leads to that 5% penalty plus the interest that goes on
Yes,
there as
which
well.
I think is 8% or something right now, is the rate that the CRA is charging it at, which is crazy. So, yeah, if you can't afford to pay your taxes, then you just need to call the CRA, and they're going to ask, okay, how much can you afford to pay and how often? So, every month, can you send us this much? So, unfortunately, interest is still going to continue to accrue, but they're not going to be calling you like crazy, because if you owe money to the CRA and they have no plan from you, then your phone's going to be ringing off the hook.
Yeah, and I mean, I have one client working, at a law firm, and the way that her payments are structured, she kind of has three different payments that come through: a salary, a bonus, and commissions. They tax. I don't know if it was something that the law firm decided to do across the board, but they're taxing, like they're only withholding about 20% tax. So again, without the appropriate planning, you look at your bill and you think, well, they're taking off the right amount of tax because they're the boss and they know what's going on here. When you look at your thing, you go, your T4 comes in, and why did I owe all this money? Well, you didn't pay enough tax. So it's about that planning thing of being able to talk with a professional and being able to figure out to plan appropriately to avoid surprises, I guess I want
Yes.
to say.
Yeah.
Yeah. Mhm. So I think we've gone over a few questions that I get, and I think you in our previous conversation you get those as well, and we've gone through a few of those. But I wanted to kind of maybe highlight a couple of specific client questions and some common misconceptions, and get your feedback on what you see out there.
Yeah. One that a lot of people think is that incorporating will save you a ton of tax. Uh, it doesn't. This CRA tax law is put in place so that you are indifferent. They want you to be as close as possible, no matter which route you're kind of taking. All it is it creates a tax deferral. So you may not have to pay as much now, but you will pay
At some point
at
in the
some point.
future, you're going to have to pay, but it's not that it's but yeah, it's not a golden ticket to save on taxes doing that.
No.
And there's other fees that come with doing that, filing a corporate tax return. There's other
Yes,
things to
yeah,
be mindful of there,
for sure.
for that one too. And for our clients that might be waiters or waitresses, and or maybe more uh, cash gigs,
Mhm.
the one misconception is,
That you don't have to report your cash income.
so you're telling me those waiters and waitresses, they should be reporting their tax, they should be
Tips.
reporting their tips on their taxes.
Yes, they should.
Yes, yeah.
Yes, yeah. Especially with the increased use of AI by the CRA, and they're going after these underground economies, as they're called. So restaurants, construction, these cash-based industries, and they're kind of saying, well, no, you worked at a restaurant, like, and you're telling me you didn't have any extra money on the side. So, yeah, you should be reporting all of that. And if they come and they see maybe you're living this crazy lavish lifestyle, and oh, you've only had like $30,000 of income, they'll actually do what's called a lifestyle audit, where they'll be like, how are you affording to live like this? Mhm.
Okay, yes. So you drive up in the pink Cadillac from that mob movie, and the boss goes, take that back right now.
Yes.
You're living above your means, and it's going to be a
Exactly.
flag here.
Big red flag.
There you go. There you go. And it's not only just cash, it's e-transfers as well.
Yes.
So, you have somebody e-transferring you, that's the same as cash.
Yes, yeah. Yeah, the CRA will ask for bank statements. And they'll say, well, you had a lot of transfers coming in, so they'll want to know what that was and why it wasn't claimed on your tax return.
Yes. So even if it's e-transfer cash, want to be mindful and talking to your accountant about how you should claim that and
Mhm.
what you need from your boss and how you should be claiming it. Yep. And I think one for me that's a tax myth is that RSPs are always better than tax-free savings accounts. So RSPs obviously have that benefit of the tax deductibility, and the tax-free has the benefit of the tax-free growth. But the RSP is more of a tax deferral, or tax shelter to tax deferral account. But it kind of depends. I always go back to what's your income and to try to decide on whether we should make your contribution to an RSP or make your contribution to tax-free savings account. If you're a higher income earner, which I talked about in my last podcast, if you're a higher income earner, it makes more sense for the RSP. And if you're a lower income earner, maybe the tax-free savings account's more beneficial. But it's not black and white. It's not always an RSP always is the best thing or an RSP is always the worst thing. I think it depends on your situation and putting that plan together, as we've said a few times here. And I get, there's a lot of commercials and things like that. And I wanted to ask you what you think about there's so much information out there in the world today, and people are bombarded with um, information from social media. And not only that, your friends or family. You're at the family get together, you're hanging out with your friends, and they go, "Oh, why are you doing this? I don't pay any tax on that." And so, what do you say about how sometimes tax advice from outside sources can be misleading? Is that
Yes.
fair? Yeah.
Yes. And everyone's situation is unique too. So
Hmm.
you don't necessarily, maybe someone's doing something one way, but maybe you don't know all the details. So
Yeah.
it's not necessarily, oh, well, I want to do that too. I can do that too.
Yeah.
Yes.
Maybe they don't. Maybe that person doesn't even know all the details
Right.
either,
I find
right?
that's often the case.
Hmm.
So
Yeah.
yeah, just yeah, talk to kind of a tax professional,
Yep.
you financial
Mhm,
planner, and
mhm.
someone who knows to get the best advice possible.
Yeah, and I think that that makes sense. And I don't mind when you get asked the question. It's better to ask the question to hopefully clarify it,
Mhm.
rather than thinking you're not doing something right or worrying that you're behind or you're not taking advantage of this or that.
Yeah.
So I'm always open. You should always ask the question,
Mhm.
and try to get some more information on it, because never know, it might be something we haven't thought about or we can get that answer for there. Yeah. What are some things that CPAs wish that clients knew?
I think don't wait till the last minute.
Mhm,
So, people think tax season is so stressful, but I think
mhm.
it's because they only think about it at tax season.
Yes.
So, this is something you should be thinking about all year.
Mhm,
If things come up, then reach out and ask, talk about it, and maybe we can come up with a plan to make it less stressful
mhm.
and hopefully make you pay as little tax as you need to.
Yeah, keep more money in your pocket, less in the government's. And
Mhm.
yeah, I would echo that statement 100%. Having a plan, talking about it, it's not that you have to look at it this every month, but a couple of times at getting to the end of the year, the beginning of the year, February. These are some good times to just make sure you have a nice plan in place. And a lot of our clients know where they're sitting right now in terms of if they're getting a refund or they're owing a little bit of money, or that, like, we've already gone through some rough initial calculations to say, hey, is this worthwhile to make an RSP contribution, to offset some of that potential tax owing? So a lot of them already know right now, as we get into March here. And that's a lot better for your mental health to know and have an idea and do stuff when you have a plan, as opposed to showing up on April 25th and going, I got to do my taxes, don't I? That's not the way to do it.
Don't do that. No.
No, yes, don't do that. You're straight from the CPA's mouth. So, you are my first official guest. I kind of had a bit of a tongue in cheek guest last month with Jerry on the podcast and doing his retirement podcast. So, I am very grateful for our inaugural outsider guest.
So honored. So honored to be here.
Thank you. Yes. And I look forward to doing this again. But on a more personal note, I want to try to end these with sometimes Jerry and I was always end with a recommendation from you, or something you might be watching, listening to, or reading, and something to let the people get a chance to know you a little bit better.
Yeah. Hmm. I think I don't know if everyone heard, but country album of the year was Beyonce's Cowboy Carter.
Okay. Yes.
Um
And we both grew up in Stouffville.
yes.
So that's how we know each other for a
Country
long
close
time.
to the city.
Country close to the city. And so you can't not be a country fan growing up in Stouffville.
No.
And sidebar here is I had the girls line dancing.
That's
So I
awesome.
had the girls line dancing because I feel like it's a rite of passage being a
Yes.
Stovilian and an ex-Stovilian now, but
Mhm.
still a Stovilian at heart. That you have to learn line dancing. Like we would
Yes.
do line dancing in gym class, right?
Yes. Loved
And
it.
square dancing and all that
Mhm.
stuff.
Yeah.
So yeah, a bit of a weave there, and I'm sorry to cut you off, but a bit of more background on how you got here, I guess. So
I think it might have just been album of the year, but I don't now I'm
we'll fact check that. We'll fact
yeah,
check
it's gonna
that. And
be
either way, you think it's a good album. It
great
might
album.
fair to say it was your album of the
Yeah,
year. Okay, there
exactly.
you go.
Yes.
So and for clients to know and for the people to know. So like I said at the start, Bianca's going to be working with us. Your company, Batty Accounting Services, going to be working with us this year, getting clients' taxes done, making sure they got a good plan in place for the future too, and trying to make it as easy and pain-free, stress-free as possible for clients, as well as the accountants that are working hard there. So
Yes. Yeah.
very much looking forward to working with you more through the years here.
Yeah, me too.
Awesome.